Greetings and welcome to another edition of the Ad Astra Kansas Money Talks podcast. I'm Joe Blubon. I'm joined by Mark Johnson and Bob Schwartz of Bob Schwartz Financial. You can find out more about them at bobschwartzfinancial.com. They have offices in Victoria and Silver Lake, Kansas. And just like the title says, we talk about all things money that deal with the state of Kansas. Sometimes we talk about things that are specific to Kansas. Today, one of those topics we're going to talk about is really not specific to Kansas. It really impacts all Americans, and we're going to talk a little bit about understanding fixed income. Millions of Americans are retired and on a fixed income, and a lot of folks don't know where's the best place to put their money to help navigate through the retirement years, and we're going to talk a little bit about that today. Once again, if you're joining us on YouTube, we encourage you to smash the bell, give us the thumbs up, and if you're watching or listening to us on your podcast provider, if you can give us a rating, we would appreciate that as well. So with that, we'll kind of get started. Mark, maybe you can start us off. People hear the term fixed income and maybe don't understand what that is. So maybe give us a quick overview of what we mean by fixed income.
Yeah, it's any investment that pays a set interest rate over a certain time period. So you're going to see a lot of 3 month, 6 month, 9 month, year, 2 year, 20 year, 10 year, but it's a set interest rate over that time. And there's kind of, there is a role for fixed income in a lot of portfolios. And one thing that I think that why we chose to talk about this is a lot of people don't understand the different options that they have with fixed income. Most times, when people come in, they only have heard maybe of CD, certificate of deposits at their bank, but they don't know that there's actually quite a bit of options that they can look at, and some that have some pretty good tax advantages.
And Bob, would you say that when we talk about fixed income, we're talking about something that has maybe less reward but a whole lot less risk? Is that the idea behind fixed income, or is it something bigger than that?
No, it's you hit the nail on the head, Joe. It's what can we do to enhance the yield on the money that we don't want to go down in value. For instance, we have a lot of ag producers that have large amounts of money for their input cost, and then at the end of the year they'll be setting on that. We'll work with them on what's the best thing to do to get the best rates of return instead of having it set in a savings account. Recently still to this day making like 0.6%. So some of them were buying CDs, that would mature. We find that there are a lot of instruments out there that have some tax advantages that have no risk whatsoever that many Kansans, not just ag producers, are not aware of. And so talk about that today.
So you hit on something there. You mentioned ag producers. So when I think fixed income, I usually think of people that are already or getting ready to enter retirement phase of their life. But you're saying that maybe fixed income is more than just during the retirement phase.
Well, I think fixed income is very, very important as you enter retirement. That's going to become a more significant part of your portfolio. But yeah, there's so many businesses that have idle cash for an emergency or for that they want to park somewhere. We certainly work with a lot of those on helping them find the best instrument to meet their needs and to have the liquidity that they need.
Sounds great. So why don't we dive into some of those instruments that you just mentioned, because there are several, and you talked about CDs. We'll kind of get into those at some point, but those aren't the only things that are available for folks to invest in.
Yeah. So the one that that we've looked into a lot more here recently, and that we've really tried to dive into and make sure that we do our due diligence about is treasury securities. And I feel like they're kind of just not, I think they're just a little bit more confusing than, let's say, CDs, and so people shy away from a little bit. But these are bonds issued by the U.S. government, so they're considered the safest investment in the world. And you can either buy T-bills, which are securities that are less than a year, T-notes, which those are the longer, your year, 2 year, and then even T-bonds, okay, these long 10-year, 20-year type securities. And then there's also these things called TIPS, which are they're inflation-protected securities that the government issues.
So let's dive into that a little bit, because this is actually an area I don't know a lot about myself. Excuse me. So when you talk about treasuries and you talk about the different durations, so a person can buy a different duration. Does that mean they have to hold it for that whole duration, or can they, sell them early? How does that work?
So there's lots of different rules here. It depends on the bond. So let's say you buy a T-bill that matures in I don't know, 6 months. So you would buy that T-bill at a discount, and the interest or the money that you make is the difference between your purchase price and then the settlement. So let's say you bought $20,000 worth of bonds. You bought 20 bonds, but you bought it for what? I don't know.
$19,700.
$19,000. You're going to pay $300.
Okay.
Yeah, over a 3-month period or whatever that be.
Calculate your yield to maturity based off of how many days it's sitting there and the difference between those prices. Yeah.
It kind of reminds me when I was a kid, savings bonds. My grandparents bought me a savings bond, and they would pay $25 for a $50 bond, and at some point in the future, it would be worth that $50.
So it's the key thing. The next lever is those can be. So we buy a T-bill for someone, and let's say it's a 2-year, and for some reason they need the money before that. We can sell them at any time. The key thing there is the underlying value is controlled by interest rates. If interest rates are going up, that treasury bond value is going down. If treasury bonds are going down, or interest rates are going down, those T-bills are rising faster than what their interest rate is. Okay, so that should click to somebody watching this in this period of time, February of 2025. We kind of feel like interest rates, even though January they went up, we kind of think interest rates are probably going to go down over the next year. So we're proactive in the treasury bill market because we think there's an opportunity to enhance our yield during that period.
And that does make sense, because as interest rates go down, instead of buying a new treasury at a lower interest rate, an investor would rather buy an older treasury at a higher interest rate. And that's what makes us more valuable.
So it'll drive the value up a little bit. So but they're extremely liquid. And I'll let Mark talk about the tax.
Okay. And what are the tax implications of treasuries?
They're going to be taxed. You're going to yield like we said, but it's not. You're going to as like normal and ordinary income. So.
Okay, so let's take that same $20,000 bond that was bought at $19,700. You made a $300 profit. You're going to be taxed on that $300 as normal income. Is that what you're saying?
By the IRS.
By the IRS.
But no state income tax.
Gotcha.
Okay.
So there is some tax benefits there.
There's that for our clients, most of the time that have non-qualified money, meaning like a trust account, joint tenancy account, or a corporate account. They're in a 7% tax bracket in Kansas, and so that's saving them money.
It's a considerable amount of tax savings.
So
absolutely.
and that's not something we talk with clients about a lot, but it is significant for our larger clients to have that benefit in there.
Yeah, the one thing that I think about with T-bills is like they're great for these. If you're very conservative investor, these are they're the safest security backed by the U.S. government, and a great option. If you're someone that's like, what's the negative? They are very sensitive to inflation, interest rates. We got to understand that, what we just talked about.
Well, and let's cover, China's buying all of our treasury bills, right?
Yeah.
Right?
Yeah.
Anybody heard that?
Yeah.
Anybody in Kansas ever heard that? What percentage do they own?
Yeah, very
Nothing.
Yeah,
it's like 2.5%. Yeah, it's not insignificant. So that's a huge amount of money. Because how does the government fund debt?
Yeah.
U.S. debt is funded with treasury notes, treasury bonds. One other quick thing to cover on that too is how many of you sat and watched CNBC market news or Bloomberg, or you listen to WIBW 580 FM or KRFM, any of the farm stations, and sometimes you'll be sitting there and you'll hear the 30-year note yields at 4.2%, and the 1 year's at 4.3%, and you sit and go, "What's that?" Well, that's exactly what we've been talking about this morning. Is that they're talking about those yields, and hardly ever happened when I was young in the industry. It's happened probably 3 times in the last 10 years where we've had an inverse bond market, which is not what the Fed wants. They want a 30-year note, let's just say, paying 5%, and they want a 1-year note paying 3%.
And I wanted just real quick, inverse means that the short-term bonds, treasuries, are worth pay more than the long-term, which is not the norm, or at least it hasn't been historically.
Right, and it's what the scare is that when they start saying we could go to negative interest rates, which I never really put my arms around that because we didn't have to. That disappeared, but I think Germany maybe went to a negative interest rate for a while, and according to my cousins over there, they had to pay money to have it in the bank.
Before we move on, I do want to touch real quick again on the risk, because you already said this is the safest, and really the only way that you could lose your investment on this is if the federal government defaults, correct? Which we've never seen in the history of our government. So it is as close to cash as you're going to get when it comes to an investment.
Amen.
Okay. So now there are many other types of bonds besides the federal government bonds. So what's another type of bonds that folks might want to consider investing in?
Yeah, so another, the other one that you're going to hear, and I don't know if you necessarily hear a lot about, but you've probably heard about is corporate bonds. So bonds that are issued by corporations to raise money. These can usually have higher yields, but you're going to take on more risk because instead of being backed by the U.S. government, you're being backed by some company that is raising capital. There's going to be a score that each one of these corporate bonds has, and you want to look up those ratings, and you usually want to look at, what are some high quality bonds if you're looking into corporate bonds, but the higher quality, the less yield. So the more risk, probably the more yield.
Yeah. I think the best way to explain a corporate bond is if you own XYZ company, you are an owner in that company. When you own shares of stock in that company, the price fluctuations, you share in that. And that if they pay a dividend, they're sharing their income with you because you're one of the owners. On a bond, you are loaning the money directly to the company. So it's just like going to the bank. Well, why don't bonds, if XYZ Corporation needs $50 million to meet payroll next week, why don't they go to the bank? Well, the bank's going to make money on them. And they know they can go straight to the marketplace, cut the banker out, and loan the money. And the one other thing I'm going to say about corporate bonds and buying individual bonds, I am not into ETF bonds or bond funds because you can't control the final value because there's never really a maturity. They'll say, well, we have a 3-year duration. Well, but that duration keeps moving. 3 years from now, their duration is still going to be 3 years. If you buy an individual 3-year bond, it's going to mature in 3 years. You buy a bond of Apple that's a 3-year bond. 3 years, Apple's going to pay that bond off if they're still in business. Mutual funds, are they safe? The bond funds, yeah, but they're going to really get hurt in a market that goes up. And ask anybody that had a bond fund in 2022 how it performed compared to the S&P 500, and they'll say, "Oh my God, it was terrible. It was almost as bad as the market." The one other thing I want to say is Treasury bonds, safest investment in the world. U.S. debt. Who owns? Who owns our country? I'm not getting political. Who owns our company? But big corporations are huge players, and so if you buy the right bonds, they're
Very safe.
they're very safe.
Yeah.
Cover junk bonds real quick, Mark.
So, though, I don't know, Big Short, you've probably seen movies, heard about junk bonds, but, if I'm giving financial advice, it usually is never going to have junk bonds in it. So, if you hear that term, it might be a very attractive yield on that junk bond, but there is a reason it is called a junk bond.
Yeah.
It has the lowest rating that you can have in any of those systems.
Below triple B.
Yeah, below triple B. But those junk bonds, the people will put them in portfolios, put them in
Put a small amount. Yeah.
Well, they'll put them in ETFs together. They'll bundle them up.
Yeah.
Try to get a high interest rate. But there is a reason they're called junk bonds. There's a very good chance that those things are going to default or not work
Well,
out.
if things go south, if we have an 08, 09, those just disappear into the night.
Yeah.
But there are people that like them. Michael Milliken back in the 80s broke a huge insurance company under the junk bond deal where they were doing that, and they were paying. I had a client that was making 9% on his money when interest rates were at 7%, and I kept thinking, well, how's that happening? And then all of a sudden, his money was the company was broke, and he had to wait 3 years to get his money out. But is there a place for junk bonds? Not in our portfolios, but probably in somebody's. But we don't deal with them.
So obviously you're not giving individual advice and everybody should do their own due diligence, but it sounds like, reading between the lines here, you gentlemen really prefer those strong blue chip U.S. companies that have a history of performance, and those are the kind of bonds that you guys prefer.
I think this is a good time to talk about what we do. And what we do is we manage our clients' money. Mark manages our clients' money. I manage our clients' money like it's our own. Not from the sense of it's ours, but I wouldn't buy a junk bond, and so we're not going to do that for clients. Mm-hmm. The other thing, and I call that staying in your lane, we're good at a couple things. I would hope we're real good at it, but we stay in that lane of what we're good at. And if somebody came in and said, I want you to develop a junk bond portfolio before you, Mark and I would say, you know what, let us do some research and we will find somebody in that space that can help you develop. Because there are people out there that do junk bonds, period, and build portfolios up. And that's fine. But it's just not a space that we're going to be in.
And before we move on to our next topic, you mentioned the ratings, and maybe just a very high-level overview when you talk about, I think it's AAA is the best, correct?
Yeah.
And
there's a bunch of different rating systems, so I don't want to bore that. But if you're think of like you're in school, if you see 3 A's, that's pretty good. You see capital A and 2 little A's, that's pretty good. So understand the more A's, usually the better on the rating system. There's going to be 4 or 5 different rating systems.
Oh, so the more B's, the better?
No, A's.
So yeah, when you get into the B's, you're starting to get to that junk level.
Well,
is
the
what
better,
we're saying here, right?
it's just the reverse. The best B is the B.
Yeah.
And then it goes double B, triple B.
Ah, gotcha.
Yeah. And then if it says NR, which means no rating, And well, we're going to go into the next one, and we're going to talk about bonds that have no rating that are actually good bonds.
Yeah, and that's a great segue because the next one we want to talk about are municipal bonds. And Mark, can you give us a quick overview of what municipal bonds are?
Municipal bonds or muni bonds, they're issued by state and federal government. So the best example I can think about at the state level is anytime a school passes a bond issue. Those bonds are sold, and you can buy them. I mean, you can buy those bonds, and there's 2 major types of these different muni bonds. revenue and like
General.
yeah,
General obligation.
Go
Yep.
bonds. So I was like, I can't think of it. General obligation and revenue bonds. So those are two major type of municipal bonds. But think of let's think my example from earlier, revenue. The taxpayers are paying for that bond, right? The progress that's being built.
It's backed by a taxing entity.
It's backed by the community or people that are paying for it. Whereas the the general obligation, is backed by
Whatever's built.
yeah
Rest home.
Yeah,
Long-term care
and then
facility.
They back it. So the company or whatever it is, I'm trying to think, is Legends?
That was Capers.
Yeah.
I don't know, but that would be a great example of a great investment.
Yeah, but-
public
So
money.
that's an example of a municipal bond.
Yeah.
Yeah.
Yeah. Well, I'll use the example only because this is when I really figured it out in 1993 when we built the gym and I was on school board.
Yeah.
Company out of Salina or out of Wichita came in and they helped. They did the corporate bonds, and we sold like $3.2 million worth of bonds at that time to build the gym and the Performing Arts Center and the junior high. And I don't know where those were sold. I don't know if anybody in Silver Lake bought them, but anybody that bought that bond, it was backed by Silver Lake School District, which has the taxing authority to otherwise if they needed more money to pay that, they could borrow more. If once it paid off, every authority always says once it's paid off, then that tax will go away. I've never seen that happen. None of us have. It's always needed for more growth. And so a next example would be we want to build a long-term care facility in Wheaton, Kansas. And we go get a general obligation bond and the city of Wheaton says, yeah, we'll help you do that, and here's a general obligation bond. It's not backed by the city of Wheaton, even though it's a taxing authority. That general obligation bond is the responsibility of paying it back is the
facility.
That facility. Mm-hmm. And more risk is involved there. They generally pay a little bit higher interest.
So yeah, let's talk a little bit about risk, because we've kind of talked about treasuries, obviously the lowest amount of risk, corporate bonds. It really depends on the company. Where does this fall into the risk tolerance? I imagine there's a range.
I think if we went out today and bought bonds for a highway improvement in Kansas issued by the state of Kansas, full taxing authority of the state of Kansas backing it, I think it's pretty safe, and it's not going to pay a really good interest rate. Where municipal bonds make sense. Okay, so I'd find that very safe. Somebody walks in and tells Mark and I that they're selling bonds for, we're going to start making cement because we think we need cement up in some area of Kansas that has no population. I'm probably not going to invest in that because that might not make it. But so generally, school districts, generally where we see people in that space is school districts and Kansas revenue bonds of like highway improvement, sewer project in Wyandotte County. So those are a lot that you'll see as infrastructure in Kansas City and Wichita, and Lawrence, because they're Manhattan, because they're having explosive growth, so they have to do a lot of infrastructure stuff, and they don't have the cash to do it. So,
and those are since those are backed by a taxing authority, you feel very confident in their ability to pay them back.
Right. And the other thing is you can buy an insured bond, which you know how when you buy a piece of property, they'll have what is it called? That they'll have the insurance that. It says that the title's clear.
Oh,
title insurance.
Title insurance, yeah.
You can buy insurance on a bond, and if that bond goes broke, they're going to pay. If that bond goes broke, I don't know how many bonds go broke and they can't pay anymore. I mean, otherwise those are insurance companies. They don't have unlimited funds to pay off. Much like people don't realize this, if all the banks fail in the United States, how much will the FDIC pay?
Good question. So when we talk about the place for muni bonds or municipal bonds, who's a good subject to want to invest in munis?
Yeah, non-qualified accounts. They're of no purpose. They're double whammy, in a retirement plan account. But in a non-qualified account, meaning joint tenancy or trust account or an individual account, somebody that has a very high tax bracket, because let's say you're in a 35% tax bracket and 7% state, 42%. Well, Kansas municipal bonds are Kansas tax-free and state tax-free.
So wait, they're tax-free for the state, but they're still taxed at the federal level?
No,
Oh, so both sides.
both sides.
Okay, so that's where municipal bonds become attractive, is because of their tax savings.
And there's sometimes, they're not always both. They're not always both tax free.
Well, not always,
Yeah.
but if you're in a
But always state.
yeah, if you're making the $100,000 today, if you're making $100,000 a year in your family, a municipal bond, just buying a T-bill at 4.3% or a CD at 4.3% is far better than a municipal bond.
Yeah, but some people get this confused. Like, I can just go on and buy any municipal bond in the country. But if you're in Kansas, to get that state relief, you need to buy a bond
Kansas.
in Kansas,
Yeah.
not
Gotcha.
go
Yeah.
buy one in Missouri.
Yeah.
Or whatever. That's where I think some people get messed up. Like, oh, this is a better interest rate. I'm going to go buy this California municipal bond. Well, you're now losing on the tax implications.
It's like buying a tax-free municipal bond fund, again, which we're not fans of. But if you have one of those, at the end of the year, you get a 1099 that shows your interest from the state you live in, from the bonds that mutual fund owns, and all the rest of it is taxable.
I think that's why it can get confusing for some people, because it's like, oh, municipal bond, I can buy whatever one I want, and they don't understand you need to buy. You don't have to, but buying from Kansas to get that double, state, federal.
So right now, you go look at municipal bonds, and that's not something we check daily. But the last time I was looking at them, they were around 2.6%. So you have to be in a high tax bracket to have that be better than
Just
a
getting
good money market.
It really is like ultra net worth. Like, this is,
Yeah.
we're really getting into,
Yeah.
the state. Yeah.
And I've actually seen wealth portfolios that were nothing but tax free. Because but then you get into the alternate tax. It's crazy stuff. But
So other government bonds, we're going to move on to our next one, which is agency bonds, and these are issued by government-sponsored enterprises. And one of the examples that we talked about was Fannie Mae. So maybe give a quick overview of what an agency bond is.
Yeah, so they're bonds issued by government-sponsored enterprises. So Federal Home Loan Bank, Federal Mortgage, Fannie Mae, Freddie Mac. They're these entities that are sponsored by the U.S. government.
private corporations, much like England is with most of their businesses, they're a little bit owned by the government behind them.
So does that mean that they're like as risk-free as a treasury since they're backed by the government, or?
Not necessarily. They're going to have higher yields. You're going to see that they're
Pay about 0.75% more.
Yeah, and they're pretty attractive, and they still are. There is some government backing to these, so not fully guaranteed. So there's a little, liquidity, and there might be some liquidity risk because they're not bought and sold as much, but they are still backed. Partially by the U.S. government, which makes them pretty attractive.
Yeah, and let's go back to 08 when it got scary. Okay, Fannie Mae and Freddie Mac fund the mortgage industry, correct, Joe?
Right, correct.
You are in that part of the game.
Most loans get bundled and sold to them.
Yeah,
Correct.
and in 08, when we had the mortgage crisis, and I'm glad that we're finally getting mature enough not to call everything a stock market crash. The market crashed, but not because of the market crash. It was because of the mortgage debacle. And I'm gonna go old school here, but one of the reasons we didn't have a 1929 was because they brought Warren Buffett in and several other very, very smart men. And one of the things they did was they kept Fannie Mae afloat. Fannie Mae was not liquid for a little bit.
Right. I do remember that.
Otherwise, if you own Fannie Mae bonds, you couldn't get your money. But they kept them above water, and that's one of the reasons. And I'm not for the bailout that was done back there, but that probably stopped 1929 from happening again, because they went in and floated those. Who'd they let go? Lehman Brothers. Yeah,
I think it was. Yeah.
Mm-hmm. They let it go, and then they brought in again Warren Buffett to be the acting CEO of whichever huge one bank it was, J.P. Morgan, I believe. And that's probably what saved us. That's probably what kept us going down 50% instead of it being 1929 and going down 80%.
Yeah. So these are attractive because a little bit more interest rate or a little bit better yield and a little bit more risk than a treasury, but still fairly safe.
Yeah, like it's better yield for moderate safety. Like you can feel pretty confident in these, and you get a little better interest rate. So,
like Mark said, what we'll do is, let's say with somebody has $250,000 that all they want is to be in fixed instruments, we might take 5,000 of that, 10,000 of that, and buy a Fannie Mae or Freddie Mac 1 or 2 year, right now 5% or so. Mm-hmm. And we haven't talked about that. Some of them are callable, some aren't, and that's going to either enhance or hurt the interest rate.
Gotcha.
Yeah, if you're buying bonds, bond is callable, it'll tell you when you're buying it, but that means that whoever's issuing it can call it at any time. So that doesn't mean you're losing your money. It just means it's gonna, at that date, it's gonna go. You're gonna get that money out that you've incurred so far. The interest that you've got so far, it's gonna come back to you.
But it might not go to the full term.
Yeah, it's not gonna get maybe to the full term.
Gotcha.
So that is a risk that you're gonna take, especially maybe with some of these agency bonds. A lot of them are callable bonds.
Okay. Well, let's move on to the next one, mortgage-backed securities. Mark, what's a mortgage-backed security?
They're bonds. We're going to a more obscure before we get to the easiest one, which is CDs next. But mortgage-backed securities are bonds backed by a pool of mortgages. So I'll let Bob explain a little bit, because he's going to be better at this than I am.
Yeah, these were big in the 80s when interest rates were high, late 70s, 80s, early 90s, because you could buy into one of these pools and make 9% on your money. Thing was when interest rates caved, everybody paid those off. Mm-hmm. And it's not like a bond. Otherwise, technically, they're going to go up in value because interest rate dropped. Well, wait, people go out and reborrow the money at 3% and pay that debt off, and that's what everybody did.
Right.
So they have a lot of risk in them. They're very, very complicated. And if I was going to do it, I'd do a Freddie. If I wanted to be in that space, I'd do Freddie Mac or Fannie Mae.
Do the agency,
and not pay attention to it.
Yeah. Well, you mentioned it. Let's move into the easiest one, or the one that I would say people are most familiar with, the CDs and the savings bonds. What are those, Mark?
Yeah, so CDs or certificates of deposits are probably the thing that most people have heard about. It's what people, that want to dip their toe into, I want to start getting interest on my money. It feels like this is kind of the entry point for most people, but they're bank issued fixed income, and they're usually FDIC insured, or they are FDIC insured, which makes them pretty darn safe.
Yeah, backed by the U.S. government.
What do we all like? You guys, of course, aren't old like me, but anybody watching this can remember on every night on Channel 13, which was the only station when I was a kid, every night at 10 o'clock, never a dollar lost, never a dividend missed, FDIC insured. I won't say the name of the company, but that was their motto, and then FDIC insured. And see, in 1929, there was no FDIC insurance. So banks failed and folded, and that can happen today. We had a lot of them in 08.
Yeah, and what FDIC, and I'm not an expert on this, but it's an insurance that banks buy from the federal government, and if a bank becomes insolvent, the federal government will make the individual investees whole up to a certain amount. And I think right now it's $250,000 per account. So
Yeah.
that's the backing of the U.S. government behind these banks.
Have we got time to talk about what happens when a bank fails?
We can always make time. So the great thing about a podcast, we have no set time to be out.
The little town I grew up in, the bank was insolvent. And my mother had money in there, and she didn't lose a dime of it. But, and this grinded her gears, along with a lot of other people, she had like a 9% CD. And the FDIC walked in, and she got a letter saying, you've got to keep your CD in for the length of time of its maturity, but we're going to pay 3%. And that was back when 3% was not acceptable. Not like last year, right, or 2 years ago. But yeah. So when they come in and help rehabilitate a bank, it's pretty cool. I mean, that's a bad thing, but it's pretty neat. They come in, accountants come in, they look at where how far what needs to be done, and then they put a bottom line on that bank, what that bank's worth. And then they start going to surrounding banks that maybe are in better shape and saying, would you like to buy this for this amount? And that's how they, it's really interesting. And it's really why when banks get audited, and I'm on a small bank board, so I get to hear about these things, they're sticklers, but there's reasons for everything. And I believe banks paid. One of the reasons bank interest has never come back like it was, I believe the little bank board I'm on was paying 0.17% for FDIC insurance prior to 2009. Since 2009, I believe it's been 0.89.
Oh, wow.
Yeah. So that means on all the deposits in a bank, you're paying that amount, and that was a significant increase at that time, and banks have to pay that, and that's why sometimes you'll hear people today go, well, the Fed funds or prime's at this, and how come the bank's that far behind it? And that's one of the reasons.
Yeah. So one of the downsides of a CD, I mean, they're very easy and they're basically guaranteed, but there is some liquidity issues with the CD.
Yeah. A lot of times lower yields, first of all, you can shop around your CD though and find a better yield. It's not like it's stuck there, which is nice about them,
Mm-hmm.
But yeah, early withdrawal penalties, especially at a bank, they're gonna, if you want to crack that CD, it's gonna cost you
Your interest or penalty.
Not your principal, just the penalty on the interest you would have made.
Yeah, where, and nowadays you could go online and buy CDs, and you probably don't have to deal with a lot of that stuff if you don't go through the bank. So there's definitely some ways. There's some things that the banks do. For example, if you have a CD with the bank and you don't go and take the money and put it back into your whatever,
sign the form,
they might throw it into the next CD, and that rate might be not nearly as good as maybe
Right.
the one advertised on the sign outside.
Yeah.
So you need to make sure that you're keeping on top of your CDs at the bank if you're doing that on your own.
And then one of the things that if you are one of those people that really wants to have it in your local bank, check to see if they'll honor. A lot of banks will honor other folks' rates as well. So it definitely worth looking into.
We certainly don't have any problem with people keeping money in their local bank, but we do have problem with these large deposit clients that we have, clients that have large deposits with us and also have large deposits at their bank. And when they sit and say, well, we're earning 2% on a huge amount of money, and you want to go, have they called you up and said there's better things that you can do? No, you know what I mean?
Yeah.
Sometimes they're not as
forthcoming.
right. And the other thing Mark and I have found out is there's a lot of people that have CDs that are getting tired of shopping them, and most people in my age group don't want to go online and buy a CD because they don't want and I understand.
Yeah.
Sure.
So one thing that we've been doing a lot, Mark does this daily, is we take care of laddering CDs, buying CDs with different maturities, and placing those. And when we look on our platform, there's probably, what, Mark, 90, 100? Yeah,
More than that.
different
Yeah.
banks.
Yeah. And I want to touch on this real quick so we can kind of wrap up the episode. But you mentioned laddering, and that's one of the things that for people that are worried about liquidity, that's something they can do where they have different maturity dates that are come due in kind of a ladder. So you may be 2 months apart, so you always have a CD that's coming due at a certain time.
Laddering's great, just.
We do it more to catch interest rates. Because Mark's going to tell you that if somebody needs to get out of, let's say somebody has $250,000 with us and we've got it laddered out, in 5 CDs, 50,000. If we sell those, if we have to break those, something comes up, no, we need that money, we can break it. You earn all interest up to that day because they're marketable.
Gotcha.
We can go out on the platform. So if interest rates go up, that CD's going to take a little hit,
Right.
but it's never been as much as that people have always made money on their CDs, even when they've had to break one.
But like I was saying, laddering's a great personal finance, getting into personal finance and laddering a CD. I think that's a really great little starter point for people.
Perfect. So, but it is a great segue to kind of wrap up our episode today because, when you think fixed income, there's a lot. I mean, we've gone over a lot today. There's a lot of different tools that people can use, a lot of different investment strategies, and some of it's fairly straightforward. Some of it's a little complicated. Once again, if folks are either needing a fixed income, for their situation, or maybe they're coming into that retirement age and it's a little overwhelming and they're ready to start working with somebody, you guys do have tools and tricks and years and years of experience that you can put to advantage for them.
I hope we don't have any tricks, Joe.
No tricks. Tools, tips.
Tricks are for kids.
There you go. All right, so a lot of good information today. I would like to welcome folks that are looking to work with a couple of great individuals. BobSchwartzFinancial.com. Go there. You can get more information how to get in contact with these gentlemen. They have offices in Victoria and Silver Lake, Kansas, but really anywhere in the state of Kansas, they can work with you. So give them a holler, and they will definitely help you through this. And once again, if you're watching us on YouTube, please give us a thumbs up and subscribe. We would appreciate that. Give us a rating on your favorite podcast. And other than that, have a great day.
Thanks.
See ya.